a lot of companies will fail to launch because they just had the wrong team. And it can be the right people in the wrong configuration. It could be the right configuration but the wrong team. But what that fundamentally means is that they were just never able to execute on their vision. They just never even took off.
Welcome to Brave. Learn from Southeast Asia's best tech leaders. Build the future, learn from our past, and stay human in between. No BS on success. I'm Jeremy Au, venture capitalist, serial founder, Harvard MBA, science fiction nerd, and dad of 2 daughters. Every week, we debate startup news, interview changemakers, answer listener questions, and share personal insights. Join our movement of over 40,000 members and get transcripts, resources, and community at www.bravesea.com. Stay well and stay brave.
Startups, they fail in aggregate and very few of them successful. But what's important for us to realize is that they fail consistently across stages. People tend to overestimate how much failure there is in the aggregate system. Some people are too optimistic, so there's all kinds of whatever. But I think one of the more nuanced things to be aware of is that later stage startups have a much higher risk than people think. So you see these companies like, 100 million valuation, but actually there's still a very large, significant chance of failure. And we've seen many large failures that happen. So these are the successful ones. These are the ones that are on Time Magazine or Forbes or whatever. So I think people underestimate the risk factor there from an investment perspective if you look past the numbers. So I think it's something for people to be thoughtful about. And so it's very important for you to be thoughtful about the risk at each stage of it. And so we talked about how, as a result, again, another number to differentiate between home runs versus most investments that don't work out. Then we talked about a case study where we talked about Jaibo, which is the world's first social robots, which was a pioneer for its time, but also eventually failed as a startup failure. And there were all kinds of reasons, right? CEO had cancer, people had to step in, the competitors came in, hardware was hardened. So multi-factors that came in for this failed, but in some ways they were also very early and they eventually were proven right in the overall thesis that people will want AI companions and digital companions. Just maybe not in the form factor and maybe not in the year that they wanted. From a VC perspective, have to define what failure is. And so we're not like some Asian mom who says, wow, you failed, you're a failure, which is one way to think about it. You can be a personal failure. You can think you're a personal failure. Maybe society thinks you're a personal failure. But from our perspective, as a VC, as an asset class, again, we know statistically that 90% of our portfolio will fail to achieve positive economic returns. And so it's very important for you to reset your definition of failure to make sure that we're talking about the business that's failed to achieve economic returns. But it doesn't mean that the founder's a failure. Doesn't mean that a failure in terms of technology. So I think that's really important. And I think it changes your attitude because, again, it kind of goes things like if you are a coach that does Olympics coaching, then most of the swimmers that you're coaching will fail to get the gold prize because only one person can get a gold prize for whatever, right? So all of us understand that in the context of sports. And then we see that in the context, for example, of talent agencies again. But again, we're looking at the economic return. So I think it's very important to separate that from personal failure versus societal failure versus moral failure versus legal failure. We're just really talking about economic failure. Again, the fact is that most people try to reduce it to a single factor. Founder was bad. They did illegal behavior. It was the COVID that killed it. There's all kinds of single reasons. But again, there are multiple reasons that can happen. And all of them can be true. So about the weightage is where the sophisticated investors will have. So for example, you guys are writing deal memos today, and all you're thinking about, is this a 10x team, 10x product? And again, most of these companies will fail. Over 90% will fail. So I think the question then comes down to, yes, you are making an argumentative piece, but you're also making a nuanced and weighted adjustment to say, okay, these are the factors that are really important versus all the reasons why they can fail. The second, of course, is fundamental attribution error. So basically people will say it's your personality versus the environment. So it's really about normal psychological bias around failure. And lastly, of course, when things fall apart, people always point fingers at each other, right? So founders say it's the investor's fault, investors say it's the founder's fault. So I think some maturity is needed. But as a result, I think we normally find that a lot of the truth of what happened to a startup often only happens maybe after 5 years or a decade after the company actually fails. Everyone's trying to pump their bags, that's what they call it, but everybody's trying to inflate their own view or personal brand. So figuring out the truth is really important. And so we talk about the 6 common clusters, which is, I think, good idea, bad partners, false starts, false positives, speed trap, bad macro luck, and cascading miracles. And so these 6 clusters probably account for the vast majority of it. A lot of companies will fail to launch because they just had the wrong team. And it can be the right people in the wrong configuration. It could be the right configuration but the wrong team. But what that fundamentally means is that they were just never able to execute on their vision. They just never even took off. The second stage that comes up is that they took off, but then they just built the wrong product fundamentally. So they never serviced about the fact that you had to solve a real problem and your solution should match that problem. Problem fit is PMF is really important. And if you are too arrogant or overconfident or you're too clear in your head that is the way to do it, then it doesn't work. For example, this engineer and founder basically said every person wants to date using data, and it turns out that nobody wants to use an algorithm as the front-facing mechanism for saying why you should date somebody. And now the whole market is using Hinge. And so I was just talking to someone last night, and he just signed up on Hinge, and now we're busy. The group was sitting around saying, what's the best profile photo for you to insert? And then he's, no, but Hinge tells me that the algorithm will automatically rotate and do an A/B test to compare which profile picture is the one that's most compelling. It's quite clear, like even individual users know that the picture is the most important thing of the entire profile and not every other part of it, which is your personality, your career success. So it's really about the picture, right? So even we know that as individual consumers of dating apps. But again, you must think about it, in 2009, nobody knew that. People were on OkCupid and doing personality matching and quizzes and all these other stuff. And I think the world changed. Then we talked about false positives. We talked about how you can have built the right product and market fit in the initial adopters. But then when you're expanding to a new geography, a new cluster, you basically didn't understand what's happening and you broke the whole system as you try to expand that earlier product that you have here. And so this happens quite a lot. And of course, speed trap is you're just way too aggressive in your growth, and then you raise too much money, and then you have too much expectations, and then basically you end up in a doom loop where basically you're not able to fulfill those things, where either you break the promises that you made, and then everybody is very angry with you, or you try to pretend that you're hitting those promises, and then that can create scope for unethical behavior or kind of like badly run businesses as well. So I think that's where we see a lot of learnings here. I think in Southeast Asia, we've seen quite a few executive teams, especially in Singapore, Vietnam, Indonesia, where a lot of executive teams basically have this speed trap. They got a lot of money, they bought. I always remember that we went to this headquarters, and then basically they built a very nice office, and then all of us were like, uh-oh, this office is too nice. And everyone's like, no, rent is very cheap here, and like Indonesia, renovations are very cheap as well. So the funding was in US dollars. So, but all of us were like, this is probably a bad sign, right? And then of course, again, it's not about the thing, but if you're thinking I can make this such a nice office, then it probably goes into a lot of the other types of spending that you have in it, right? So it's like a gut check. Now, obviously, I'm not saying that if your office is too nice, if we're going to disqualify you. That's one of the signals that investors will often see is this kind of, does this actually make sense as an office space? Is it too much office space? Does it make sense? Do you have the right people? So this is a twitchy intuition that VCs will try to evaluate you on as well. Basically, is your leadership sound and solid as you continue scaling? Now, of course, we talk about bad macro luck. So we've already seen multiple ways of this. Right now, we saw recently crypto winter happen with FTX collapse. It was a Sequoia investment. Now we have Southeast Asia funding winter that's happening right now, especially for Series B, Series C capital. So a lot of companies that previously raised seed and Series A are struggling to find capital for Series A. And the smarter ones I have already navigated before that. A lot of them maybe were caught too late or didn't understand it too late. And then they basically, a lot of them had to close down or downsize quite aggressively. So I just had a call last week. We had a discussion with another emerging country VC. And then the conversation that we had was quite funny because basically everybody on the VC kind of knew that this startup was not doing well. But then one day the founder just called all the VCs and said, we've already run out of money. And then all the VCs were like, what are you talking about? Your previous accounting was that you will give you like 6 more months. But then they're like, we redid the math and the environment is bad. And now we just want to become a zombie company and lifestyle company. And it's all the VCs like, you deploy X $million, and I was like, now it's like zero. And other things are quite key. So I think you have to be thoughtful about that. And of course, we're talking about cascading miracles. These are the most famous types, where these are the people who look the most visionary. And obviously the press loves these kind of stories. And we tend to put these giant expectations on them because people want to change everything. And I was just on a panel with a bunch of other VCs. And so, for example, what we had was one of the VCs basically said, hey, just 2 years to 1 year ago, ESG was really hot. And now this year, the climate has changed. And people are like, if you're trying to sell a ESG solution to a company, the company is going to be like, does it make me more profits? Otherwise, DEI is out. ESG is out because everybody's in like tightening mode for their cost controls, etc. So we have to be thoughtful about that. And some of the companies that are out there promising past 2 years, you imagine there were some companies or features. We are going to solve carbon neutral, we're going to plant so many trees or carbon credits and going to solve the world. And then now it's kind of like falling apart for a lot of them because it turns out it's very hard to convince companies to buy carbon credits because they're like, oh, my competitors are not buying carbon credits, so why am I the sucker to spend money on these carbon credits, for example? So I think it's interesting because I know somebody who was trying to sell carbon credits 10 years ago and then he gave up because he was disillusioned. And then 2 years ago, everybody was like, carbon credits are back, net zero, blah, blah, blah. And now it's going away slowly. I think this quarter, the hype around ESG. So if this is true, then you can imagine that a lot of these ESG companies are going to go into trouble next year, next 2 years in terms of the funding. I think we have to be thoughtful about these miracle stories they often read. But the truth is, they are true as well. If you think about it, the world has to get to net zero eventually. Otherwise, everybody is going to go through all these natural disasters and so forth. So eventually we'll get there. But as we all know, humans love to procrastinate. I think things are going to go really bad. And then everyone's going to be like, oh shit, now it's really too late. And people are going to scramble to solve with technology and all these other things. But to some extent, there's a certain dynamic, right? So I do believe that these ESG startups will eventually have their time and shine. But when the market timing happens, when the critical mass, when the regulators approve, it's like the big question mark. I think this wave of startups could make it. I hope they make it. I think that makes a better life for my kids. But I also wouldn't be surprised if people don't want it to happen, right? So I think that's a big piece about it. And then, of course, for a lot of founders, they have to make a decision between three major paths. One is they can move on from their startup, they can wind down the company and then start a new life as a different person, different startup, a different job, different profession. Or of course, they can choose to build another company again, and we see that many founders are now serial founders. They may rebound into the closest available startup that makes sense for them. They can do a revenge to go and they feel like they were wrong, they want to attack it again. Of course, rebirth is basically saying that they want to build something totally new for a new problem that they have discovered as well. And so what they were able to prove is that angels are beneficial for startups' growth rates. Good angels, means these angels are strong angels, were able to be 14% more likely to survive 18 months post-funding and hire 40% more employees than those who did not receive angel funding. Also increases the probability of successful startup exit by 10% up to 17%, so from 7 to 70%. So obviously some of these numbers, definition of exit also were not just big exits, but also smaller exits in their definition pool. But the key thing was just saying is that it makes sense, right? If you are somebody that's a new founder, you're getting some angels who are in your, let's just say you're selling to HR officers, right? Then if you have a bunch of angels who are HR officers, people can sell your product and promote your product to other HR departments. Obviously, that's going to benefit you because you're building in that team and they're also aligned with incentives because they're putting money in you. So when your company value goes up, then their incentives are aligned with yours as well. And so one of the big suggestions I often with founders is a lot of founders are like, oh, I can do it. A lot of big VCs are writing these very large seed checks. And I remember at that time I was telling a lot of people, be like, don't take one big check from a VC. It's better for you to take small checks from 50 small angels at this stage of the company because you want more surface area to increase your luck and serendipity and network, right? So that's like the debate that does happen. Of course, today, most founders now are going back to angels because VCs are not deploying that much capital in the early stage anymore. The second piece that's also important is that successful entrepreneurs have about 30% chance of succeeding in their second venture, whereas first-time entrepreneurs have about 18% chance of succeeding on their first time. And for those who have previously failed, so now they're going to the second startup, they have a 20% chance. So in other words, if you're doing a first-time startup, 18% chance of success. If you failed and now you're doing a second one, it's about the same outcomes. You didn't learn that much. Maybe statistically you got 2% more odds from learning. You did the right reflections. But successful entrepreneurs do have a significantly better probability of success. And this is something that's well understood in the VC world. So in many of the quantitative VCs, so VCs that have quantitative engineers, they would often try to source and look for how much entrepreneurial experience and scoring their prior experience. That's also being done qualitatively. So VCs will say, oh, this person is a successful entrepreneur. Keep me in mind for your next company and hang out and all these other things. So I think it's a well understood fact in VC land that if you're a successful entrepreneur beforehand and you're doing it again, the odds are much better. And of course, that's helpful for the deal memo selection, but also in terms of how VCs are assessing the odds from that perspective. That being said, what this paper also tried to do was why are they more successful? How can we decompose that into several aspects? But basically, I think there are three major components. The first component was really about both skill-based and perception-based, as well as attracting resources. The big skill that they had was market timing. So one of the things they assessed was that successful entrepreneurs are better at timing their companies. Companies that were, a lot of them failed because they're just too early or even too late, right? There's actually a good, interesting dynamic where starting the time where it's like early, but not too early, and you're ahead of the pack. If you think about it, the crypto boom, as we all remember, was about 2020 to 2021 for that time frame. So the people who made the most money were people who started at crypto in 2015, right? If you think about it. So you had a good run, etc. And then, but the people who started in 2021, a lot of them were doing NFTs and stuff like that. And then a lot of them their companies have wound down, or some of them are even going to jail because they just end up in the wrong process and they were in the downswing of that market boom. So they were too late to the market timing. There's also managerial skill as well. So another piece is succeed breeds success. Entrepreneurs who are successful are able to attract more resources. So for example, like you as a first-time founder, you have $1 million of funding, you can hire 5 employees who are above average. But somebody else who's a successful entrepreneur who is calm and confident, has that same $1 million, could maybe hire 5 people, but hire 5 excellent people instead of above average people. So the quality and the quantity of those inputs of attracting resources is key. And so again, the key thing about the difference between an entrepreneur versus a manager is that a manager is given resources and then they do something with it, right? Versus an entrepreneur is somebody who wants to do something and then they attract the resources to do that thing. The ability to attract resources is such a key aspect of being a successful entrepreneur. Being compelling, sales pitch, attracting company money, attracting customers, attracting talent, attracting supporters. All these things are really key aspects of this entrepreneurial piece. And of course, the last component is, are you a good manager? Are you actually able to be competent in doing those things? So those are the 3 major aspects about it. That being said, what's really interesting was that if they divided into 2 tiers, top tier VC funds versus lower tier VC funds, what they saw was that top tier funds were able to improve the performance of first-time founders. However, if you're already a successful entrepreneur, then it doesn't matter if you get your money from a top tier VC or from a low tier VC, your success is still the same. Which kind of makes sense, right? If you're like a really Olympic gold swimmer who's already won Olympic gold, the value of a very good coach is much less to you than if you are like somebody who last time got bronze or silver and now you're trying to get a much better coach. Obviously, there's more performance gain that you can get from a better coach. Again, this is super obvious when we talk about it, but I think there's something that we need to think about in the context of entrepreneurship and VC funds. So VC funds can add value, but we add more value to people who are first-time founders, and founders who are already successful tend to be more tactical about who they choose, but also try to find VC funds and talent that complements their weaknesses.
Thank you for listening to Brave. If you enjoyed this episode, please share the podcast with your friends and colleagues. We would also appreciate you leaving a rating or review. Head over to www.bravesea.com for member content, resources, and community. Stay well and stay brave.